Hello, everyone, and welcome to the Altos Trading Live strategy session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us in the chat. Well, we're glad to have you guys here with us this week. We've got a lot of great information to go over. Jeff's got some wonderful things to show you guys. And it's Tuesday, it's 7 o'clock, so let's kind of get into it. This is your first time on. You notice that your microphones are muted. That's how we can all hear Jeff and I talk. But there is a Q&A box at the bottom of your screen if you just move your cursor a little bit. And you can put any questions in there, and we'll get to those throughout the evening and also at the end before we sign off. If you have to hop off for any reason at all, you lose connection, don't worry, this is recorded and will be available later tonight in the members area and sometime tomorrow on YouTube. And if you're catching us on YouTube, we got tons of new subscribers coming in week after week. We've noticed that the numbers are growing pretty well. Just like and subscribe, and you'll make sure you get all of our future videos moving forward. So we're definitely got a lot more coming to you, and we're going to keep this going. We've done pretty much one every single week so far this year, Jeff. So definitely excited about that. And let me read the disclaimer before I bring on Jeff. Altos Trading LLC and Trade Zillion software is intended to be used as an information service for subscribers and includes opinions as to buying, selling, and holding various stocks and other securities. However, publishers of Altos Trading, Trade Zillion software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstances of any particular person. Say that 3 times. Altos Trading LLC includes owners do not accept responsibilities for any decisions made by subscribers using the software. Subscribers to the Trade Zillion software or any other person to buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. Awesome. If you have any questions about your account, access to Trade Zillion, trade alerts, subscriptions, anything like that, email support@altostrading.com, and we'll get to those sometime tomorrow. We won't talk about that stuff throughout tonight because we have a lot of good stuff to go over, right, Jeff? You there?
Yeah, we do. I'm here.
You might be muted.
Can you hear me?
Let's see here. It looks like can't hear you, Jeff.
Let's see.
There you go.
Oh, you got me now? Okay.
Yeah, I got you now.
Weird. I didn't do anything different, but might have just taken the mic a little while to warm up. It's still cold.
Right. There's so much good stuff coming. It has to warm up first.
Exactly.
That's what we're doing.
Yeah. I didn't want to have a mic and a camera problem because still having camera issues in the office here. So we'll get that.
I still think you're at Hooters, man. Okay.
Yeah. Just don't want to reveal where I'm calling in from. That's the real reason. Or my office is messy. You have a cleaner office than I do.
Well, that's a picture. So, I won't be like that one person we know that's got all the hoarding stuff in his office.
Yeah, exactly. Right. Well, welcome everybody. Great week to have everybody on. Lots of great stuff to cover tonight, as Richard mentioned. So we'll start out with our market overview. We've got some really important levels to keep an eye on for this week on the major indices. We'll also review the 36-month moving average, which we probably glossed over a little bit too much. I think, was it last Tuesday was our first, or was it the one before, our first Tuesday session of the month, just because we did have we had some closes above the 36-month moving average with subsequent close below in September. And that's something that we need to take a closer look at in terms of how that might impact markets for the rest of 2022 and beyond. So we'll do that. We also didn't follow up on our short strangle last week. I got so excited about the price action pivots. If you guys didn't watch or attend last week, that's now posted on our YouTube channel. You can take a look at last week's session.
That was awesome.
Yeah, we got a lot of great feedback on it and really enjoyed sharing that strategy. So again, if you guys weren't in attendance, you can check that out on our YouTube channel, Price Action Pivots. Great price action strategy that doesn't require any indicators for determining and forecasting market direction on any asset in any time frame. And also, really ties into a lot of the other technical analysis that we do. So had a great session last week, but then got so excited that we didn't follow up on our short strangle simulated trade that we put on the week prior. So we'll follow up with that. It looks really nice. And actually is at a point where it can the whole spread can be closed out. So we'll go ahead and reinitiate a new simulated trade with a strategy tonight. So again, if you guys didn't attend that week, you can go back and review. What was that, Richard?
You have to be a subscriber. You've got to subscribe on YouTube.
Yeah,
If you can't make it, those videos are always there.
Yeah, you guys don't want to miss them because we build on things week after week. So nice thing is they're there. Past sessions are there for you to check out. But again, we do these almost every Tuesday, so you don't want to get too far behind there. So we'll recap that, set up a new one, and then since we do have some significant market impacting events and announcements this week, we're going to talk a little bit about a good way to identify those and the potential impact they might have on the markets. We've continued to see quite a bit of volatility, and we're going to likely see that pick up tomorrow and Thursday. So I'm going to show you guys how you can spot these in using the ThinkorSwim platform and use them to your advantage. And then we'll open it up for our ticker roundtable. So if you guys have any stocks or ETFs or forex pairs or anything you guys want to look at, futures contracts, get those ready, and we'll do our ticker roundtable. So all right, let's start with our mapping out our key levels on the major indices. So we've seen this rotation lower, as I warned you guys about on our session last Tuesday, to watch out for dynamic resistance at the center Bollinger Band. And sure enough, we saw the rotation higher from the lows in late September up into that dynamic resistance, and then a subsequent sell-off late last week and into this week so far. So we actually not just the dynamic resistance center band, but mapped out the static horizontal resistance at the 3800 century mark. So we called that one nicely before we even got up to it last week. So hopefully you guys use that to your advantage, kept it in mind. So that is a strong resistance level now. Was before we rotated lower from that level, but continues to be strong resistance. And then we've got some resistance below that 3800 level around 3750, 3725 to 3750 is also going to be a key resistance level. And then also right around 3650, 3640, 3650. So we've got a few layers of overhead resistance to contend with if we get a rebound. And we'll talk about what might cause a rebound this week. Technically, the markets are oversold. Another interesting thing that occurred last week is on a fundamental basis, if we just look at inflows cash inflows into the markets, there was actually a really big buying spree last week. Of course, we saw that here off the double bottom rebound. But it was the fifth consecutive week of inflows. And what I mean by that is how much money is flowing into equities and ETFs. And that's, tracked by a lot of banks. I think Bank of America put out a report on equity inflows. And it was actually the third largest inflow into the equities market, going all the way back to 2008. So from the housing bubble and market crash of 2008, last week was the third largest inflow. And what that means is that the broader market participants are anticipating that we're at a near bottom in the markets and anticipating a rebound from current levels. Now, we want to take that with a grain of salt. We don't know that that's necessarily going to be the case, and there's plenty of technical factors that would disagree with that. But it is an interesting consideration and something to keep an eye on. So we've posted some new low closes on the major indices. We're in basically technically oversold territory. You'll notice that we're within 2 standard deviation move from the 20 period average, and we've got a lot of downward momentum and volatility. So as far as support goes, today, let's see. So we closed below the 3,600 level. So actually, I'm going to mark that as a resistance as well, because it's a century mark. And since we closed below it today, I want to watch that one for tomorrow. Because if we stay below 3,600, that's going to create a greater likelihood of trading down into the lower volatility band, which is a 2 standard deviation moved to the downside from the center band. So I want to keep an eye on that. So what I'm really watching for strong lower support in terms of a horizontal level is right around 3,500. And as we see the lower 2 standard deviation band diverging from the middle and upper bands and pointing downward, we may see that meet this 3,500 level, which would add to the strength of that support. So if we do see the S&P come down into 3,500, I believe there's a strong likelihood we'll see more buying come in and prices move up from there. But we've got a ways, 88 points and change on the S&P to get down to that level. So that's our near term, our strongest support level to watch. We'll also want to keep an eye on the half century market 3,550. So we might see some more minor support hold there at 3,550. And as I mentioned, we're going to expect more volatility tomorrow because tomorrow is FOMC minutes. There won't be any announcement of a rate hike or anything, but it's going to be more of the tone of the Fed that moves markets tomorrow. So expect more volatility tomorrow. And then Thursday is CPI. So we really want to expect volatility and more clarity on directional moves after CPI on Thursday, because that will tell us what the inflation was for September. So through the rest of this week, expect volatility to continue and even accelerate. So those are key levels on the S&P. Let's take a look at the Nasdaq 100 Etf the Queues. So new yearly lower close for the year on the Qs for 2022. And here we also have some strong overhead resistance around 270, going back to mid-June lows and the rotation off that level. So we're pretty bearish here, but we have encountered the lower volatility band. So that we closed off of that today to the upside, but we tested that 2 standard deviation band today on the Qs. So we'll watch that as kind of a support level. And then particularly like 250, which is down, going to be lower, are going to be levels where we might want to watch for rotation. And the catalyst that will drive these, so here we have resistance, support. So the catalyst that will drive a rotation higher off of this most recent sell-off would be Fed minutes tomorrow and CPI Thursday. But overall, the message is be cautious on rebounds because even though we had this really extreme buying last week, and we've seen that in previous weeks. They're resulting basically in bear market rallies. So we want to be, not get too excited on rebounds and watch really closely these overhead resistance levels for a reversal of any rebound we get. So this is also a resistance I wanted to point out on the Qs. And likely we'll see the coming days, we'll see the middle band come down into that level. So remember this, our volatility bands are dynamic support and resistance. They're not, a set level like our horizontal support and resistance. They move intraday and day to day. So we'll want to, monitor those on a daily basis at least. So those are the key levels there. Now let's look at the VIX and what the VIX is telling us in the context of these indice levels. So on that most recent market rebound last week, you'll recall that we emphasized this resistance zone on the VIX, and then if we come up into this zone, and then so we're trading up from lower levels into that zone, and then reject it to expect a rebound on the market. So that played out picture perfect on that particular week prior to the rebound actually occurring. We found support on the VIX right around the 29 level, and again rotated higher, but now we're back up near that resistance zone. So now what we want to watch as the indices, the Nasdaq and the S&P come down into support, we want to watch to see if the VIX rotates lower from the resistance zone. And that's our indication that we have a higher likelihood and we're forecasting a rebound in the markets. So again, why it's so crucial to use the VIX as a forward-looking analytical tool alongside the levels that are mapped out on the indices. So this will be a really crucial resistance zone to watch on the VIX this week. So let's see what happens. We didn't quite come up into the zone today. We had kind of VIX indecision, so a lot of volatility with no real directional movement from the open. So what we might expect to see is volatility picking up again tomorrow and Thursday because of the FOMC minutes and the CPI report, which could cause the VIX to spike up and get into this zone, or at least near it, closer to it than it did on the high today. And then we want to watch for the rotation lower as the indices come down into support and rotate higher due to the inverse correlation there. So when we see that, that's our tool for forecasting a rebound in the markets. And then from there, we want to, again, use the resistance levels for, where we expect the markets to move up into and maybe encounter profit taking or short selling. All right, so let's pause there. And Richard, have any questions come in for the market analysis?
Yeah, Mike had kind of an interesting question. I'm not sure it's more of a question where we can give an opinion because we don't understand, we don't know the ends of it. But he was saying tomorrow morning at 8:30 the PPI figures are going to be released, and he's wondering if the results of that could potentially really dictate what's going to come out with the Fed later in the afternoon.
Yeah, and PPI can have an impact too, and we'll look at the various reports that are coming out when we get into the topic for tonight, which is key market influencing events and how to find those and analyze them. And there also are a lot of great free resources on the web that kind of try to give a weighting to the significance or the market impact a news announcement or an event might have on the markets. So those can be used as well. But yeah, that anything that, because these are all kind of tied into inflation and those types of things, and we'll talk a little bit more about inflation as it impacts the markets, can all have obviously a more sustained impact on directional movement in the broader indices. So, yep.
Cool.
But just remember, again, the Fed's not going to be raising rates or making any, major policy announcements tomorrow. It's more just kind of the state of the inflation. So, traders and our investors are going to be listening in for more for tone, for dovishness or hawkishness, and that's going to really dictate the volatility and the directional movement tomorrow. And then, of course, CPI on Thursday is really going to, because that's the hard number, is really going to impact directional movement. Any other questions there?
That's all I got.
All right, so let's also quickly look at the 36-month moving average, and then talk about how things have changed since July, August, but particularly last month, September, because we had found. So this is a monthly chart. Each candle represents a month's worth of price action, and this is the S&P 500 index, SPX, and we had rotated higher from this. And historically, the 36-month moving average is a reliable level of support in the markets, mainly the major indices, and can be a good, zone for buying on more of a medium to longer term basis if you're more of a buy and hold investor, or also on a timing basis if you're looking to time market reversals after sell-offs and things. It's a good mean reversion point on the major indices, but on more of a micro scale and looking at particular months as we're trading around the 36-month moving average, something significant happened here mid-year, and as we mean reverted into the 36-month moving average, again, we found support in July and then rotated higher in August, but it was a bit of a false rebound from the 36-month moving average, because then we got a close below the average in September. So the way that I use that information is when I see a close higher after testing the average. So 2 months we came down and touched, or in this case traded below, but we want to look for a touch or a trade below the 36-period moving average on the monthly chart. And then we see a subsequent close back below. That historically often leads to more selling in the medium to longer term. So again, we might see some what we call bear market rallies within these monthly periods, but on a bigger picture perspective, we tend to see, in a more longer term perspective, we tend to see a continuation of a sell-off into lower levels of support. So since we got the close below the 36-month moving average last month in September, we need to pay close attention. And we've actually already broken that low this month in October. So not only that, we came back up and tested and found resistance. So if you're ever asking, well, how significant is the 36-month moving average? And we've done past weekly sessions on this. That's how significant it is. It's so closely watched by institutions and hedge funds and the like that price literally came up perfectly and touched it and found resistance there this month, and then rotated back lower. So because we closed below last month, we'd want to look at that, and we did in past weekly sessions, emphasized, because I think the time of our last session last Tuesday, it was right around 3,800, which, as we just looked at, corresponded to horizontal resistance on the daily S&P chart. So there was that confluence between the 36-month moving average resistance and the horizontal level resistance level on the daily charts. And look how perfectly that served as resistance. So we're very, on a technical basis, very bearish when we get closes below the 36-month moving average, particularly a close above and then a close back below, and particularly if we get multiple monthly closes below that 36-month moving average. And this actually occurred, let me go further back on the chart, back in 08. So again, you can see like in past sell-offs and mean reversions into this moving average, we've gotten nice rebounds and sustained market uptrends following that, the test of that level. But when it doesn't play out that way, and 08 again was an example, you'll see we got the close. So we tested, started to get a rotation higher, couple monthly closes above, and then there's the subsequent close below in the following month, and then there's the big sell-off below. So that's what we want to watch out for and be careful of. So if we see it again, another, and we likely will see another monthly close at the end of October below this moving average, you know, our bearish sentiment, you know, is going to remain and strong and increase really until we get back above. And you can see back in 08 and then throughout 09, because it wasn't till the following year, 2010, that we finally got back above, and then we went into this decade-long secular bull market. And that, you know, this could lead to that too, but that's the rationale for using the 36-month moving average on the indices. That period is not arbitrary. It's not selected just because, you know, 36 months sounds like a cool, you know, moving average. It's not, you know, arbitrary at all. It's based on how secular bear markets work. So they tend to be, you know, shorter lived, and the reason why we often see mean reversion, and then even if we trade below the 36-month moving average, when we get back above it, we see sustained secular bull markets, as we did over the past decade. So our expectation is that if we this continues to be a bearish month in October and we trade below, that we could hit much lower levels on the S&P and also the Nasdaq. So on a more of a medium to longer term basis, but by long term, I mean just even going out a month or two, watch 3,400 is a very strong support level. And you'll see why, because if we go back to right before the COVID crash in early 2020, we see strong resistance there and a big rotation lower. We also marked right around 3,500. So again, we're looking at a monthly chart here, but those are going to be key levels. And then, oops, redraw that, 3,000. So millennial mark. If and when we do get down to 3,000, that you know, we'll reanalyze when the time comes if it happens, but could be a very good buying point on the S&P. Oh, and then one other thing too I wanted to also point out is the retracement level. So we'll just use Fibonacci. So if we go to the lows from March 2020 to the high at the start of this year, you'll notice we're also coming down into the 50% retracement level, and that's at 3,500, which we just looked at as a major support level on the daily chart. So again, we could find some near-term support at the 3,500 level. So if we see rotation off this level, and we could encounter it as early as this week, this would be a very strong level of support and potential rebound. It could be very short term and not real significant in terms of directional move in points or percentage, but a likely area that we'll see a reversal and rotation higher. So keep an eye on that 3,500 level very closely as we come down into it. And then more medium to longer term, we're looking at 3,400, 3,200, and then 3,000. Okay.
That's something. Yeah. One question came through, this is more of an opinionated question, but do you think the sell-off that we're having right now will be more aggressive since the bull market from 2010 to 2020 was so aggressive? You see that will be
I
dropping
think
off.
partly that. Generally, the longer the secular bull market, the more significant the bear market, but also in the context of inflation. That's probably the real variable and catalyst that's because that can have much longer lasting impact on the markets. So if it takes longer to get inflation under control, remember the markets always tend to lead that. So we may see, and very likely will see, the markets rebound on a more sustained basis before we get back down into reasonable levels of inflation. So we'll likely see the market lead that. So even while inflation is still high, as long as we're seeing it come down, and because last CPI kind of shocked people and we didn't get the drop that was expected, because it takes time for these interest rate hikes to have an impact. We'll see that lead, so inflation will still be high, but as long as it's coming down, we'll likely see the market rebound and even exit bear market conditions long before the inflation levels, before core CPI gets down to a reasonable level. So right now, people are just looking for it to start retreating so that the Fed doesn't have to be so aggressive with interest rate hikes.
Yeah. Moshe's asking the last question here. Besides the 36-month, does you think the 50-day, 100-day, 200-day have any significance? He says the 50 days going to be hitting right around 3,500. Right? That's
yeah. Those are also closely watched averages. So you'd want to look at those on a daily chart, not on a monthly chart, because then you'd be looking at very long term. Remember, the moving average is fractal, so it's relevant to the time frame you're looking at. If you look at a 200 period moving average on a monthly chart, you're looking at 200 months of data. But on a daily chart, a 50 and a 200 are also significant. So it's particularly, as Moshe said, particularly if it coincides with one of the century mark levels that we've mapped out. So that could just lend more significance to that level for a potential reversal. So if we're selling down into it, mean reverting down into that average, we want to look for buying and a rotation higher from that level.
okay. That's all I got.
Moshe said, Mundle equals monthly bundle. Yes, exactly. That's what was going through my head. Okay, so, all right, so that's our market overview. Sorry, it took a little longer than I expected, but some key things to really consider there. So glad that we spent the time on it. Let's go back and look at our simulated trade on the short strangle, which was a strategy and topic we covered, I think, a few weeks ago. And we went ahead and set up a short strangle on the S&P 500 index, the SPX, and went through the whole strategy, how to set it up, how to manage it, etc. So that, again, if you didn't attend those sessions, they can be found on our YouTube channel. But let's just recap, because this one actually could have been closed out already, I left it open through today, but actually this one worked out really nicely. So both sides of the short strangle, the short put side, which had a strike of 31.50, and then the short call side with a strike of 40.25, which were at right around 10 deltas when we set this up, played out really nicely. So even though we've gotten all this volatility and all the extreme directional moves in the S&P index, you can see how the strategy really handled it nicely. So recall we set these up with a relatively far out expiration. We set this one up with like 40 days to expiration. So we still have 24 days till these contracts expire. But I also mentioned when we went over the strategy, our intention is not to hold these up until expiration. And there's really two factors where that would cause us to exit. One is a P&L factor. So when we hit right around a 50% profit on either side of the spread, or both sides, which in this case we have, we would exit with a profit. If we don't have much of a profit, or we're making adjustments to the spread, then if we come up to about 21 days, so we're close to that now because we've got 24 days, we would use a time exit. So even if we don't have the profit level that we're looking for, we would exit and readjust the spread, set it up as a new spread at the 10 deltas on the put and call side. So again, that's all covered in past sessions. But again, so we just did one contract on each side. Since we are selling a naked put, a naked call on either side, even one contract on the SPX would tie up a significant amount of margin. So this can be done also on index ETFs like the SPY or the Qs that trade at much lower prices and would require far less margin. But you'll notice that our trade prices here, on the put side, we sold the 31.50s at 24.60 and the 40.25 calls at 14.50. So we've actually already far surpassed the 50%, because that would be if on the call side, if the calls were trading at 7.25, that would be an exit, profit target exit there on those. We did the same on the put side, but last week, I believe. But again, I kept these open because we forgot to recap the simulated trade on last week's session. So we're now back a little bit above the 50% profit target level, which would have been at 12.30, so half of our the premium of our trade price, our entry price on that. But the overall on the spread, one contract on each side on the put and call side resulted in a P&L of $2,070. So both put and call side profitable. And so now this one can be closed. So when we close, what we can do is we can just go ahead and reestablish the spread at new strikes. So I'll just set up another one real quick here for demonstration. And we can track this one as well. So we didn't need to make any adjustments to that one. And there's actually another adjustment technique for the short strangle trade that I'll demonstrate if it comes up during the life cycle of this new simulated trade we're going to enter. And again, keep in mind, this is a simulated trade. We're not trading this with real money, and don't suggest that you do either. This is purely for demonstration purposes. And if we were to put on a real short strangle, we'd want to do all of our homework, map out our levels, etc. So I'm not going through any of that due to time, but just demonstrating how to set it up. And then there's another adjustment strategy that we can use, and it's a hedging strategy if we get one side of our spread gets in trouble. So if that happens, we'll continue to put these on weekly, and we can monitor that. So for now, again, we want to start out going about 40 days out in expiration. So I'm going to select the November 18th expiration, which has 38 days before expiry. And if we look at our deltas, oh, sorry, I'm on the IWM. Let me get over to the SPX. Saw those prices. I was like, there's no way the market's just crashed and I missed it, or there's no way the S&P is trading down in the low hundreds. Okay, so
But if that did happen, you took it pretty calmly.
exactly.
La la la.
Yeah, I would have been getting over to my other computer and shorting the futures really quickly.
I know, right?
Okay,
This session
so
is over.
right. Let's see. Okay, so and a lot of times you'll see this on the S&P. You'll see multiple strikes with the same delta. So in this case, like we've got the 3090s, 3100s, 3110s, all or 3100, 3090, 3080s, all a 10 delta. So I'll just select the century mark level. So the 3100s. Now think about how far below, that's 488 points below the current closing price of the S&P today, with a expected move up or down of 308 points between now and November 18th. So we're well outside the expected move at the 3100 strike. We're at a 10 delta, so we only have roughly a 10% chance of the S&P closing below that by November 18th. So we can use the 3100 on the put side, and then if we look at the call side, let's see here. We've actually got, and I'll tend to go a little bit higher on the call delta because call premiums tend to be lower due to the demand for puts for hedging and protection things. So I like the 11 delta here at the 4,000 because it's at a millennial mark. And again, we're far outside the expected move, which is again plus or minus 308 points. We covered the expected move and how to use that in our short strangle session a few weeks ago. So 4,000 on the call side. So let's go ahead and just set a simulated trade up here to demonstrate how to do this. So if we go to the 3,100, we're selling a strangle, 3,100. And then on the call side, we're going up to the 4,000 strike. And we'll just go ahead and do the simulated trade with one contract again. And I'm going to put this on as a GTC, good till canceled. And our midpoint's 37.65. Well, actually, I'm just going to put it in at the natural. Normally we use the mid price, try to get filled at the mid price first. But just to make sure this thing gets filled tomorrow. So in one contract, our max profit is 3,710. Remember, our goal is to close the spread out at about 50% on when either side, the put or the call side, hits a 50% profit target. So we expect, in best case scenario, kind of like the last simulated spread we put on, we'd be looking for about half of that as a total profit for the spread. Remember, these are limited reward, unlimited risk trades. So, be very cognizant of the risk that you're taking on these. And we also looked at that, how to determine that using the risk graphs on the previous sessions. And you can see that in a portfolio margined account, this trade would hold almost $36,000 in margin. So it's a very margin intensive trade on the SPX, but again, it could be done on the SPY for far lower margin. And that obviously is all going to be correlated to how many contracts you trade. So we'll go ahead and send this one through as a simulated trade, again, just for training and educational purposes. And we'll follow that one as well. So
yeah, I just ran the numbers for Steven. He was asking if you can do it on SPY, and It's just like you said, it's just it's roughly $3.74 credit. Buying power effect is roughly 35.78.
Yeah, it
So,
should be about a tenth of the.
yeah, the 10th.
Yep, it's going to be a tenth of, because that's how the SPY is correlated in exposure to the SPX.
Yeah.
Okay, cool. So yeah, we'll keep an eye on that one. And that's it. Unless there's any other questions, we can go ahead and get into. And we ran a little bit longer than I expected, but it won't take very long just to kind of talk about key market events and how to find them in TOS, ThinkorSwim, and then look at some of the data's expectations, etc. And again, this can all, when we look at this, can all be tied into all the knowledge and education we're building on each week in our sessions. So the expected moves and a lot of the options analysis and strategy we use, even if you don't trade options, very, very critical technical analysis tool for analyzing even equity trades. So any lingering questions there, Richard, or can we move on?
Now we can move on.
All right, so and we will wrap up with Q&A too, guys. So all right, so in TOS, in the upper tab menu bar towards the top of the screen, if you go to Market Watch, you'll see that you have a number of different tools that you can pull up: quotes, alerts, finance rates, etc. At the end is calendar. So calendar is where we're going to find key market impacting events. And you can set this kind of configure this to your liking. I like to have it just on the day for each week, and then I just show the week. So I know for the week, what we're looking at. And then you can also select what you want to show up in the calendar. Right now, I've just got everything selected, but you can look for things like dividends, earnings, stock splits, futures liquidations, ETF dividends, etc. The one that for like news events or important, market impacting events, it's specified as a Kana Day event. So we want to make sure you have that one selected. So right now we're on Tuesday, right? And here's where you're going to find the date and time of the event. If it's related to a specific symbol, if it's more broader market, you'll see it'll just say NA in there. It'll say what the event is. It'll give a brief description of it, and so you kind of have that all in one nice, easy to read view of everything that's going to happen on that particular day. So as one of our members tonight pointed out, we've got PPI tomorrow. So we've got a lot of Akana Day events. So if you look at coming in tomorrow, so there's the FOMC minutes that I was talking about. So you can actually click on these, and it's going to tell you like what the event is, what they're doing. So like FOMC minutes, detailing the issues of debate and consensus among policymakers of its latest meeting 3 weeks after the meeting. So it's basically just telling us like what is the event, what's taking place, and that's a good way to get an idea of whether it's something that a number that's going to be reported, or if it's more like of a debate or consensus meeting, and then it'll give a description. So this can also give you a nice insight into what's happening at the event and how it might impact the markets. So TOS does a really nice job at providing this, and some of it, when you don't see like any expectations or numbers being posted as we don't with the FOMC minutes, that's good to know too, because then it kind of gives you an indication of what this is about. Is it going to be more emotional reaction to the tone of a meeting, as will be the case with the FOMC minutes tomorrow, or are, market participants looking for looking at a very key number, as they will be on Thursday for the CPI. So we'll look at that one here too. And again, you can see the time. Oops, sorry, I clicked out of that. You can see the time that the day and time the report comes out, so you can be aware of it. And you can also set alerts. So if you want to look ahead in the week or at future weeks, you can be aware of what's coming up and set an alert for yourself so that you don't forget about it. So really nice way to provide this information and keep us on our toes and be aware of what's coming up. Okay, so we've got CPI on. So now I'm on Thursday, right? And again, this is listed as an economy event. So if we click on the CPI release, which is at 6:30 a.m., I think that's my time. I think it's 8:30 Eastern. I think this is all, I'm in Mountain Time, formatted for my time zone. So here's where you're going to see, again, the date, the time, but now this is a release of, consumer price index data. So it's going to have more information on what's coming out, what's expected, what the previous move was, and you can actually look back and see, to give yourself kind of an expectation or indication of what the market reaction might be. What happened last time? What was the expectation? Where did it actually come in? And then what did the market do? So that can be helpful too. And that's all provided here. So the expected inflation CPI number is 8.1%. All right, so we know what the expectation is, and then now we can track and see what it actually ends up being. And basically with CPI, especially in the context of unusually high inflation as we're in now, if it comes in lower than expected, then we anticipate the markets to move up. If it comes in higher than expected, or even if it doesn't change and it stays elevated at the same number, we might expect the markets to move down. And so again, you can look at the description and it gives you all of the information about CPI and what it's analyzing, referencing, how it might impact the markets. And see it's listed as the most widely followed monthly indicator of inflation. So obviously we want to pay attention to that and how it influences the markets. Let's see. So this is, again, you can read through this at your own leisure, but all really good information. And it also describes some of the past numbers as well and how to analyze those. All right, so those are really the two big ones, and three if we include PPI as well, to watch for this week. And you can make sure that they're populated in your calendars and even set alerts for them so you're ready for those when they come out. So really handy tool within ThinkorSwim to monitor key market moving events that are upcoming. And then we can also track, once the event occurs, how the market's reacted. And that's a great exercise to do, because over time it will help you get a feel for how markets react to each of these individual key events. So again, I gave you the kind of the inside scoop on the CPI, and but always take that reaction in the context of what's happening on a broader perspective. So a bump down in the CPI is probably not going to have a major long-term market moving impact when inflation's already low. But since we're at such high inflation, any move down and we've had such a significant sell-off as a result of that in the markets, any move down in CPI, any lower number than expected, is going to have more of a dramatic impact on upside movement in the major indices in the broader market.
Yeah, these news events are key. You can definitely see setups kind of really kind of come together around these big days. So it's always good to know what's happening kind of ahead of time. You're paying attention to all that. And someone wrote, there's another counter they use, and it's actually the same one that I use, called a forex factory.
Yeah.
.com/. That's the one I use the most.
Yeah, I've used that one as well. It is a good one. So yeah, if you guys don't have ThinkorSwim, looks like Keith posted in the chat the link, which is forexfactory.com, and then you can navigate over to the calendar there. I believe, if I remember, it's been a long time since I've used that one. I believe that one also specifies like the magnitude of the impact it might have on the market.
Yeah, basically you just really just look for the red day, the red items that are.
Yeah,
really gives you the heads
so it's
up.
kind of nice it does that, because I don't believe that ThinkorSwim tool does that. So
That's awesome.
all right. Well, any other questions there?
No, looks like it's pretty clear. Quiet group tonight. Not a lot of people on.
Yeah. Well, that's okay, as long as it's
in.
Right, as long as it's sinking in. So yeah, just another tool that I wanted to emphasize to use in, these should all be used together. So you don't want to just use one thing individually to make trading and investing decisions. These all really come together to make us more confident, consistent traders and investors, and more informed traders and investors. So this is a great tool and resource, or forexfactory.com. If you guys don't have ThinkorSwim, there's other ones out there as well that can be used with the technical analysis that we've emphasized on our weekly sessions, with our support and resistance levels, our volatility bands, the Bollinger Bands, and all the other tools and strategies that we cover every Tuesday. So hopefully that's helpful to you guys. And with that, we've got a little bit of time left to do some ticker roundtable. So maybe we could take a couple symbols if you guys want to take a look at any individual stocks or ETFs or forex pairs, futures contracts. If you want to run some analysis and take a look at those, we can do that here in the last few minutes. So if you want to put those in the chat or the Q&A.
Steven's first. Quick fingers. APA.
Quick fingers from Steven. APA. Is that Apache? Yes. All right. So we're looking at a daily chart of Apache. And it looks like it took out a trailing stop from a long signal from Trade Trend. Came in back in early October. There was the buy warning. There was the triggered entry. Got a nice run up here. Obviously very strong resistance, kind of right around 43. So stock's in a bit of a range at the moment. So we see the resistance area there, and there was our trailing stop. So this one on the signal would have picked up, looks like a few points, not a bad one. If you're not using the trailing stops, the horizontal resistance level, if you done your homework and mapped that out, would have been a nice profit taking zone between 42 and 43. Could have done a little bit better on that long signal. But what I'll point out here, because it was our strategy last week, is the price action pivot, and we've got one that just set up on Apache. So this would be a supply price action pivot, or demand, or a short price action pivot with the expectation or forecast of a move down, and it was right off this resistance level. So I'll just kind of highlight that. So we've got a series of two higher highs, followed by final higher high, which is our pivot candle, And then we've got two lower highs to the right of that for a supply price action pivot. So these 5 candles make up that setup. Again, we covered this strategy last week. There it is. And a short trade, we would look to take off a move a number of ticks below the low of the final or 5th candle of the setup. So we get follow through down below the low of today's candle, which was at 39.87. We may see a continuation of this rotation off this resistance level back to the downside. And then with the price action pivot strategy and really any directional trade, the Bollinger Bands come in very handy for dynamic support and resistance. So since this is a short price action pivot setup off of a resistance level, and we're forecasting a move down in the near term, we're going to, and if we were to take a trade off that setup, we're going to really want to be looking for our support zone, where we may find, if we were to take a short position, price stall or reverse from, so that we don't get, into a successful trade that then turns around on us and wipes out all of our profits. Or if we, we don't want to get caught off guard if the price stalls there and, we're still in an open trade that is tying up capital or exposing us to risk, when it may make sense to get out. So it looks like kind of right around the 37 to 38, more specifically 37.50 to 38. 38 coincides currently with the middle Bollinger Band, would be our support zone. So this one could pick up 1.5 or so if the setup plays out and we get a continuation of the move down. So we got strong support there. The real range of this is more like, if we look at the bottom of the range, well, actually, let me make it a little bit wider. It's kind of between 30 and 32. So if we break this support zone, that's between 37.50 to 38 roughly, then on a more medium to longer term basis, assuming this stays in the range, could see rotation to even lower prices to this 30 to 32 support zone. We've got some other areas of support to keep an eye on as well. If we were holding a short trade into these lower levels.
I think that's a very good callback you did there, Jeff.
What's that?
With the pivot points.
Yeah, I just spotted it. I mean, because and hopefully you guys are practicing these and like, just always before you ever trade anything, you want to practice. And you saw, how quickly I think it was Steven that suggested that this ticker Apache. I haven't looked at this chart at all, but I was able to see that very quickly. So the more you look at them, your eye gets trained to spot them, and you can spot these really quickly. And there was some really nice ones previously too. So here's a supply price action pivot. There's our pivot candle, and then our entry and big sell-off. And then we got another one. So again, for a short setup, forecasting price to move lower, we're looking for 2 candles to the left of the pivot candle, which is our high, to be lower, and then to the right of the candle, again, we're looking for those to be lower, 2 candles on each side. There's our pivot, and then breaking that fifth candle low, there's a sell-off. And we actually had a demand price action pivot here. Right, so we have to the left of the candle, 2 higher lows. There's our pivot candle. And then to the right of the candle, we have 2 higher lows. Fifth candle here. Entry would be a few ticks above the high. And we got the follow through, and there's a nice demand price action pivot. So quite a few of them here on this chart, just on the daily chart on Apache. So that was a good one to look at. All right, let's take another one.
Paul asked for Zillow, Z.
Okay.
Or Zed for the folks over in the UK that are staying up.
There you go. Oh, I don't think we have Zillow in our database. We'll have to get that one added. Will you make a note, Craig or Richard, to add Zillow into the Zillion database?
Will do.
I'll go over to.
Too bad, Paul. I'm just kidding.
What's that?
I said, too bad, Paul. Better luck next week.
Yeah. I'm just gonna get
There
rid
you
of this and add our Bollinger.
Trusty old TOS there.
Yeah. All right. Over to Zillow. So we got some pretty tight sideways price consolidation on Zillow, which is currently at a very strong level of support. And this one's really stuck in a channel or a range with resistance here at the top of the range, support at the bottom. And also what we have going on here is volatility contraction. So you'll see that we've got the outer volatility bands converging. With today's move down on the stock, a little bit of divergence in the lower volatility band. But you can see that in the previous sell-off, when the volatility expansion was peaking, we had very wide bands. So our real support zone here is kind of between the lower band, which again is dynamic and will move day to day, but right between 26 and 2650, and then we've got this strong level of static or horizontal support right around 28. So if we break 28, we might see a rotation lower into the lower band. So that's going to be a key level to watch. And what else did I want to point out here? And also we can look for a demand price action pivot for reversal back up, because right now we're in the midst of a supply price action pivot. Actually had a couple of them, one followed through today, but there was one here. So there was the break of that one, but then also, actually no, that one is not one. Take that back. Yep. So we're still in that one I just drew there for you. So this one's kind of in the midst of playing out. So if we see a demand price action pivot near a support level, like we just mapped to 28 or the 2650 to 27 support zone, those are going to be good levels to watch for reversals and rotation higher. But again, the stock's really in a pretty tight range, and we're near the bottom of the range. So as long as this support level holds, and the stock's obviously taken a really big hit, not just this year, but going back into 2021 when it was trading up above $100 a share. If we can hold some of the, the strong support level, I think we have a strong chance of a rebound up into the top of the range. which is going to be kind of in the 35 to 38 zone. All right, let's take one more.
All right, let's see here. This next one looked very similar to one you've already done, so let me skip that one and do fold, F-O-L-D. This one looks a little different.
Okay. Amicus Therapeutics. Sounds like a volatile biotech stock. 6.24% move today. Yeah, so I've seen a lot of things here that we've covered in past weeks, like a slingshot. In terms of key levels, looks like for support, we're rotating higher off a key support level, which is right around 10. Draw this one up to make it a support zone between 10 and about 1040. And also, oh no, we're still, yeah, well, it's kind of more volatility contraction, but so we closed, the stock closed above the center band today. So, and it's rotating off a support level. So we want to be looking for resistance on any long positions up near the upper band, kind of right, and also horizontal resistance. We see a lot of resistance here right around the 11 level. And if we hit that level and don't rotate lower, instead keep moving higher, we could see a slingshot to the upside and volatility expansion if price trails up the upper band with higher support around 1175. But over the past month or so, the stock is in a range. So this is definitely a ranging play with the bottom around 10 and the top around 11. So these can be a bit trickier. Ranging, conditions can be a bit trickier to navigate and trade and make trading decisions off of. So it's really, again, key. Watch these levels, and those are the key ones I'm seeing on Amicus. We may also see a demand price action pivot. Almost, unless we get a huge sell-off tomorrow in the stock, very likely will. So I'll also point that out for you. It hasn't completed yet. And if we do get a move up in the stock into resistance, you always want to be careful, because the forecast with a demand price action pivot is that the asset will move up, and with a supply price action pivot, it will move down. This being a demand pivot, if we get up into this resistance level around 11 tomorrow, you want to really make sure this ends up being a volatility expansion. Price trails the upper 2 standard deviation band, and they diverge, can still create, a channel breakout type of setup, which can be really nice, but just really important to keep an eye on that resistance level and make sure, if there's a demand price action pivot, that you wouldn't want to take long positions right into resistance. But you'll see that we had a series of lower lows here over the past several days. This is our what is looking to set up as our pivot candle, because today we had things shifted and we now have a higher low than the previous day. So it went from downtrend, pivot candle. So tomorrow, if the low of tomorrow's trading, the range, is also a low that's higher than our pivot candle, then we've got a demand setup. So let's just say, hypothetically, our lows, this was the close, let's just say our lows right here, and the candle, let's say, just closes up here. Then, let's say it closes right near resistance at 11. We'd want to look for follow through above that, the high of that candle, tomorrow's candle, and also, keep an eye on static and dynamic resistance on any long position. So this could be a breakout candidate if we can get above this 11 resistance level and we have a demand price action pivot. Great. So those are some great ones to look at, and we'll again continue with our ticker roundtable tomorrow. If you guys want to come prepared with more symbols to look at next week, and as we always say, but seldom do, we'll try to leave more time for that. We just get so wrapped up in our strategy sessions, and those are really the most important. So want to make sure that we cover everything thoroughly there, but at least we got to look at a few this week. So let's go ahead and wrap up with any final questions for the night. If you guys have any final questions or comments or any suggestions for topics for future weekly sessions, go ahead and put those in the chat or the Q&A. Thanks, Keith. Appreciate that. Thanks, Moshi. Raju.
Looks like everybody's just glad to be here. A lot of thank yous. And Keith said earlier, it feels like all those traders are like playing whack-a-mole right now with the market.
Yeah, it really does. It's like somebody hits one of the moles and it pops up somewhere else, and then it goes back down. Yeah, and again, just to recap, really expect that through. I mean, this could extend for quite some time, but expect it through the week, particularly because of the FOMC minutes tomorrow and then CPI Thursday. Those are going to be create more volatility and difficult conditions. So again, really monitor these levels. Keep an eye on the news release times. Be aware of them, and use all the other strategies and analysis and systems and things that we cover in our weekly sessions to help you navigate these difficult times. So with that, yeah, we'll be back again next Tuesday. Hope to see you guys all back next week. And hope you guys have a great rest of the trading week. Stay consistent, stay profitable, stay safe, and we'll see you guys next week.